Hello there. I'm back and we're going to talk about understanding the different types of real estate markets that are out there. You know, we've got 50 states that we can invest in and they don't operate in the same way. So let's start with this and so we can understand this and understand what type of investments may work better in some places and not so much in others. And it doesn't mean that you can't do it all, but let's kind of break it down. There's basically three markets that I think about. First of all is a cyclical market. Then there's a linear market. And then there's a market that kind of combines elements of both. And so let's kind of define these and use some graphs to try to illustrate what I mean. Cyclical markets are typically markets that have large upswings and downturns. And they're very much a timing market. In other words, you don't want to be on the wrong side of it. For instance, I own property in Florida, and I use this as an example because it's definitely a cyclical market. California certainly is another market that's been cyclical. And the thing is, you want to buy on the right side. And fortunately, I did. Now, it's hard to time it perfectly. It's just like saying, I want to buy a stock at its lowest point. And, there's no way to define that. But the thing is, these cycles go longer than a few months. And that's why, even if maybe you're not at the absolute bottom, that you're still in a good position for, that market springing back. And if you look at Florida, that's just the way it is. Now, one of the things that's good in a market that is like this, that has these large cycles, is fix and flip. And the reason why is economic downturns create hardship, and hardship creates foreclosures, short sales. And this has always been something that's big in a market like Florida. And so if you're buying, as you know, as we talked about before, fix and flip, you need to pay the least amount of money possible, mainly because you're looking for your profits up front. You're probably paying a bunch of interest, especially if you're using what we call a hard money lender. And so you've got to have a margin there of error. But this can be very, very good. Now, it doesn't mean that you can't do like short-term rentals because that's what we own. In other words, we're off the ocean and people love to go there for vacations. And so it's an ideal spot, just like the mountains of Colorado. Going to be a little bit more expensive, but they can really, really return a lot. So again, I'm just using fix and flip as number one, but short-term rentals here, they also do extremely well. And, understanding historical data is extremely important. And that's why I point out the Case-Shiller Tampa Home Price Index from the St. Louis Fed. And you can see from the 1980s on that, again, we started to see a peak in 2022. Now, statistics are not there afterwards, but it is still going down there. Now, how far down? It's hard to say, but you can see during the recession, the big one, the Great Recession, started in 2008, that you can see that there was a huge downturn. So if you were buying from there, as you can see into 2012, that's what made a lot of sense in that particular market. Now, linear markets have a small but steady upswing and are good for long-term investments. So here's an example of a market like Oklahoma City. The red line that you see that starting quite a while ago is the United States. And you can see that kind of was going up nice and steady. It peaks, went down quite a bit after the Great Recession, and then it's way up. The blue line is Oklahoma City. So the number one thing that you see is affordability. In other words, compared to the United States, it's a lot less money. And that's where a linear market can make sense for long-term investments. And the other thing that you see is, starting, from the oil bust, basically what happened in Oklahoma, Texas, and Louisiana onward, even through the Great Recession, you can see that it didn't have a downturn. Kind of flattened out a little bit, but then it steadily went up. So it wasn't depreciating. There wasn't a tremendous amount of foreclosures. So if you're looking for linear markets, they're affordable and they're really good for the patient long-term investor. So Oklahoma is a great example that I use. Omaha, Nebraska is an excellent example. It's a little colder up there, but You can possibly find other markets, maybe a little bit farther down south, that might also fit into this profile of a linear market. So it's a conservative market, it's an affordable market, and that way you can start building up more property. So I usually think of linear markets as a bedrock market before you take any flyers on something that may have a much higher risk. Not saying that a little bit more risk is a bad thing, but you want that baseline that really works in your favor. Now, there's markets that are combination markets. Phoenix is certainly a market that comes to mind to me. As I've watched Phoenix, sometimes it acts linear and sometimes it's acting cyclical, mainly because of the incredible spread that's happened, and it just gets larger and larger. And so some of the outlying suburbs and feeder cities have some real problems. This is an example of Indianapolis. Again, you see the United States, and this is even more graphic about that downturn in 2008, then kind of coming up, flattening out, and then going up. But if you look at Indianapolis, it kind of looks linear and it kind of looks cyclical. So in other words, we see it going down, going up, going down, going up, going down, going up. That's an example of that. And it's not like the cyclical market where you might have 2 to 4 years or 5 years in some cases where you can make a really, really good investment. So it's a good market. Indianapolis is an excellent market. But if you look at this timing, if we go into these later years, you can see that it's having some gyrations. I'm not an economist. I can't tell you what's going on in Indianapolis, but obviously that is the case. So again, the thing that we have to decide when we're investing in any of these markets and any types of properties, long-term, short-term, fix and flip, what is our risk tolerance? What are the reserves that we have against the worst case scenario? And certainly fix and flip is your greatest risk of anything that you do. It could also be the greatest profit, but you need to have some serious reserves for it. If you want to go linear, then you're talking about lower risk. So this is really up to you. But again, this is coming from me. This is my way of thinking, and maybe it's hopefully yours too, is start conservatively, build up that base level, all right, before you get into other things. And understand, reserves are always necessary. It's not just the fact that the mortgage companies want you to show some reserves in order to get the loan, but you need reserves that are even larger. I did 3 months in one of the modules, but having 6 months or a year is also not a bad idea, especially if we're getting into some craziness as we go forward in the United States market. So think about higher risk coming later, thinking of risk like a pyramid. Again, that base level, those are your conservatives. And then you can move towards possibly doing something with a higher risk, higher return that doesn't kill you and kills your wealth position. So I kind of went through that. I wanted you to understand those 3 types of markets so you can kind of think about how you fit into that. Maybe you're living in one of those markets, and that might be a great idea for you to follow through on the types of investments that make sense there. So now that we define those markets, the next thing I want to go into, and again, there's a bit of bias here, but is why you need a specialist and a turnkey solution. This is the situation where it's very important for you to get the best type of advice that you can from somebody that understands investment property backwards and forwards and can give you the best advice possible. So stay tuned. I think this next module is going to be very important to you.